Good morning. Welcome to a Mindset Meets Mechanics portfolio considerations, where we look at real world portfolios, real money portfolios, those that are being traded by ShareWealth systems with real money and have been going for over 9 years now. And also LTTP, learn to trade properly, public portfolios in inverted commas, because these are customers, some over 200 trading with their real money, and we're going to talk a bit about those portfolios today, and a little bit maybe question mark position size mistakes with large price stocks, so we'll cover that today as well. Right, before we do that, have to tell you everything we covered today is general investment advice. There's no specific or personal investment advice. Okay, what do we do here? Just quickly, for those of you along for the first time, we cover the two SPA 3 investor public portfolios, ASX US and the leverage portfolio. Just one slide up about that. Don't talk too much about it, but the objectives is this is warts and all real world conditions. We'll talk about a couple of customers' experiences in the past over the last 2-3 years, and we'll just use those as examples to talk about what people go through, traders go through, active investors go through in the market. And this is all about building functional trading habits and skills that can get you through. And sure, a mechanical system plays a major role in that, as those of you who are going through LTTPs will know. And it's all about, as with anything, any personal endeavor, executing under pressure. Yep. Whether that's the market or individual sports or even business, you've got to be able to execute your processes under pressure. Okay, talking about the LTTPs. There's a number we're going to go through today. For those of you will be going through this, 20th September we started one. Dave facilitates those and coaches people through those. 9th of December, there's the 3rd of February ASX and 3rd of February USA. And then there's also 31st of March or April. And there's also one that started in June as well.
That's right.
Just a week and a half ago, and I think the first trade's been done in that.
Yeah, it has.
In the US one.
Yep.
And in Australia.
And Australia as well.
Okay.
Yep.
So those are up and going as well. And the next one will start in the beginning of August, first Monday in August.
So there's lots of live portfolios, Gary, that we're now accumulating. So it's not just the ShareWealth systems ones. There's, like you mentioned, there's a couple of hundred members out there that are running these public portfolios as well.
Correct. And the beauty of it is to us use this as real world portfolios, is that they all started at different times and different conditions, but same system and same habits and skills required to execute. And so we'll track these over time. All right. So let's keep going with that. The current conditions, US market, we've been tracking this from that peak back there in 2021. I think it's around about July. No, it's just after about September 2021. The US market is up 25%. That's just the S&P 500, not the total return index. And the All Ords is up 11.4 in that time from that peak back there. So the same period. This was a couple of things caused this. One was DeepSeek coming out. We'll go up to the US portfolio and have a look at that one. DeepSeek started this in March, and of course, it's come out that the $6 million wasn't true, and then a little bit of a bounce, and then Liberation Day in early April, massive V bottom, 61.8% retracement, which is very unusual in a secular bull market, but now trading pretty close to those highs again, all-time highs up there on the S&P 500, and the Australian market is, although it did report yesterday on the ASX 200, I think made a new all-time high. The broader market, the All Ordinaries, hasn't yet. Okay, so that sets the conditions under which we've been operating. ASX public portfolio update here, going back to 5th of August. The blue line is the ASX SPA 3 investor public portfolio, red line accumulation index, and the black is the ASX 200 without dividends. So running at just under double the performance over the last 10 months. So But we'll also have a look back at further performance as well. Now, that's obviously outperformance over that period of time. Over the whole life of the portfolio, new all-time high. Certainly that was achieved over here, back into the range, and then new all-time high. So sitting at $245 odd thousand is where that public portfolio is, having started at $80,000 9.4 years ago. And importantly, outperforming the accumulation index by about, if you look at total dollar return, you can look over here at top left, about $55 odd thousand is what it's got more profit than the ASX 200 accumulation index. So 206% versus 134% in total return.
An interesting point there when I'm looking at these, and probably getting into this particular slide itself, Gary, is that we make the point that indices spend up to 90% of their time in periods of drawdown. So they're only really making those all-time highs, maximum 10% of the time. And so, wanting and living this particular equity curve just means we need to be comfortable with those periods of drawdown.
Absolutely. And I think I've got a chart that's in my analysis somewhere of I think it's the NASDAQ, with all the drawdown periods that occurred in secular bull and secular bear markets. And they're just littered with 10% and greater or less than minus 10% drawdowns. And they're just everywhere, right?
Everywhere. Yeah.
And people talk about 10% drawdown as being their threshold. And, well, that's just way, way too low a threshold to be a successful trader or active investor. Yeah. That's an unleveraged markets. Go to leveraged markets, where most people kind of swarm to like the honeybees to a honeypot, and it's just they're just rife with greater than 10% drawdowns everywhere. So we have to be able to handle this, and we're going to talk about that in a moment when we go to this slide. So this here is the ASX public portfolio, and every one of these red underwater, if you like, negative drawdown periods is a less than equal to 10% drawdown, minus 10%, I should say, if I'm using less than equal to. And there's been 10 of those in the life of this portfolio.
And this portfolio has been going for about 10 years now.
9.5. So 9.5 in about a couple of weeks' time. Yeah. And but there's also been 3 that have been less than minus 15% drawdown in that period of time. And as you pointed out, there's been drawdowns, 10% drawdown within a bigger drawdown over here as well. So really, that's really testing times. Yep. And obviously quite a long sideways move here before making a new all-time high there and there. But I think the point is that every single drawdown, by continuing to execute consistently with confidence and trusting the system and truly accepting all of the risks that you encounter in financial markets, is that it's made a new all-time high every single time. And therein lies the most, I think, difficult thing that people, having been in this business now for nearly 30 years, in fact, it's already 30 years, it's the 12th of June will be it will be 30 years since we got our first customer. Is that is the number one problem that people face, is being able to continue executing in the face of adverse market conditions. So that's just given that 10% drawdown is what we're talking about. Right, let's have a look at US relative performance now. That is over the last 2 and 3/4 years, basically matching, has outperformed the total return index, S&P 500 total return index over that entire period. This period has definitely tested the trend following system, sharp falls there and coming up and not coming out as fast as the S&P 500 over that period of time, and what 3 percentage points in total return over that 2 and 3/4 years. But certainly holding up there, given that most hedge funds and managed funds are performing way worse than that. And over this period of time, certainly got to within cooey of matching. We've outperformed most of the time. This 2002 certainly found out run up here with the investor portfolio and being tested again, and now a bit of a wide band opening up. But we're going to make that up. We will make it up in time. But certainly the performance is holding up, and 11-12% compounded per annum in US dollars is pretty good but being a strong market period in the US. The relative performance of the leverage portfolio, big drawdown here. Whoops. There was a 50% drawdown, and now still hasn't come out of that total drawdown yet, but still sitting over this 2.5 years at 280% return compared to 72% in the S&P 500 total return index. And these drawdowns there, the leverage environment, are magnified. That's 13, that's a 20%, there's a 24%. Sorry, that's not 20%. I can't see that's hidden behind there. And these are all greater than 15% drawdown. So if you want to really test your ability to come out of greater than 15% drawdowns, then go to leveraged environment.
That's it.
One closed trade on the ASX in the last month, Regis, which was a 21% profit since the last session we did, and one in the US, 11% loss on Fair Isaac Corp, and that was the same with the leveraged portfolio, just the one over that period of time as well. Okay, let's get into talking about the skills acquisition plan. Had the slide up before, so
so this is what we teach in as part of Learn to Trade Properly, and the skills acquisition plan or skills acquisition plan portfolio stipulates as part of the key objective is that we want to be able to execute using a mechanical investing system, which everybody has got, and SPA3 Investor. And we need to be able to go through and actively manage those portfolios through at least 2 periods of drawdown of at least 10%, but preferably 15. So 10% obviously is the first mark in the sand, line in his sand, if you like, to say, okay, we're now starting to feel a level of pressure. There are lots of 10% periods of drawdown, Gary. So let's just wind the challenge up a little bit more and stretch ourselves that little bit further and make it 15, preferably, if we can, because if we can get through 10 and down to 15 and stay in the flow, and therefore come out of drawdown by remaining in the flow, then that's going to be key milestones for us in terms of being able to benchmark our skills against what? Well, when you think about it, we've got other public portfolios, and we've got a person who has traded for many, many, many years and has had a close association with Mark Douglas and learned all the mindset skills to enable he to execute a portfolio. And here I'm talking about Gary and the Sharewell Systems public portfolios, such that we can start to benchmark our skills against Gary, somebody who walks the walk and talks the talk, that we can model our behaviors upon, our habits.
Thank you, David. But it really, I was talking about this to somebody recently, where it's got to a point, and I'm not trying to brag or anything over here, where it is difficult for me to convey what it is to be able to just pull the trigger with no fear whatsoever, because of the total acceptance of all risks, the trust in my ability to execute in a system that I trust, but also trust the market, and also trust my ability to execute, to pull the trigger with absolutely zero conflict going on in my head about what may or may not happen, and totally divorcing myself, disassociating myself with the future in terms of what may happen. Anything can happen, but also totally disassociating with any negative, because that's what takes us out of the process, out of the zone, any negative experiences in the past, and therefore staying in the moment. But it's not a conscious decision anymore. It just happens. Okay, and that is where we know we are getting a lot of clients, particularly over the last 7-8 months with the Learn to Trade Properly study groups. We're getting people to that, and we know because they're telling us, right? Yeah. And some of them are now starting to go. Some of you are now starting to go public with this, and it's the only way you can do this is not to read about it, only read about it, is to actually live the experience. It has to be a lived experience where you clash, who you are at that time clashes with the uncertainty, the adverse conditions, the fears, the frustrations, and continues to execute through that. And how do you know what's the first step? Well, certainly to go into the drawdown, but then what's on the screen now is to come out of that drawdown and achieve a new all-time high for the first time after having been through those adverse conditions.
Yeah, and that's, I mean, Gary, one of the lessons in the Learn to Trade Properly digest that we've created was about the SWAT teams and how they learn and how they put themselves under a controlled amount of stress to be able to execute. And I think this is a thing where a lot of people have read Trading in the Zone with Mark Douglas, and a brilliant book and so much gold in that book. But sometimes we miss the gold because we're not thinking, we haven't quite got that link in terms of the way that we need to think. And that's where the beauty of James Clear comes in that he actually helps us to bridge the gap, if you like, between what Mark talks about and actioning and actually transforming that physical and mental transformation that we've got to go through. And, like you talk about, I've got a great little quote here that I've just got on my phone that I've just been looking at. And it says, chains of habit are too light to be felt until they are too heavy to be broken. You just heard Gary talk about the way that he is, thinking about, or maybe even not even thinking about, because he's become so used to the habits are so ingrained now that he couldn't think of operating in any other way. And that's exactly the journey that members that are in Learn to Trade Properly at this point in time are going through. They're starting to realise that they are starting to think a little bit differently about their actions, that their actions are now being really habit focused, and that's what we're trying to achieve.
Absolutely. And it's that can only be done through a lived experience. You can't theoretically read about it and think, yeah, she'll be right, she'll be apples, I'll be able to hack the pace when it happens. Ain't going to happen. You're not going to be able to hack the pace, right? You have to live the experience and go through it. And that's really what that quote says. You have to feel and come through the adverse conditions. You have to feel the feels. You have to feel the stress that the SWAT teams talk about, and then come through it. Otherwise, it's all just theory. And until you've done that, what people do, what is the biggest thing they do, is they give up. They stop the diet, they stop the exercise, they stop the trading. Why? Because the emotional pain, as Mark Douglas tells us, just becomes, that one little millimeter, inch, whatever you want to measure it in, too great for them to carry on. And all they can see is is the current environment they're in, being associated with past emotional pain, and it just becomes too great. Why? Because they haven't lived the experience of coming out of it, facing their fears and coming out of it. And that is what we try and do in the Learn to Trade Properly study groups. And that's what we are doing. Not trying to, we are doing it.
It's one of the lessons that we cover. It's about those primal thoughts that we talk about have kept us, allowed us to survive in the physical world. The fight or flight type of response, which has been extremely beneficial to us in that environment. But the market's completely different, and being able to, think about that and go through a series of, structured control, levels of stress, etc. And these benchmarks that we're talking about here, the skills objective, we talk about the slack wire, all sorts of different analogies, metaphors, etc. But they have a whole, they have meaning to everybody, that when people start to visualize themselves walking on a little slack wire an inch above the ground, that's going to have some feeling. And so we don't need to be thinking about, walking, between two high-rise towers when we're doing this. We're just looking to build up our skill set, layer upon layer upon layer.
And I think the thing to add to that is that you just have to do this, right? And that's the only way. So we're going to look now at a couple of portfolios that have achieved that, right? And the first one is the ASX 20th September LTTP that started back then, and it's fully invested now, 9 positions, and it's this is a month ago. So do you want to talk us through this a little bit, Dave?
Yeah. So the portfolio, again, when we're looking at these equity curves and we think, well, September, we're not even 12 months into it yet. And so it's a very small window. And Gary mentioned earlier on about needing to generate the sufficiently large sample size. So we need to keep that in mind, but bearing that in mind as well, we need to think about the objectives, the 10% drawdown that we've gone through, and coaching a group of members, and all the members at this particular time are going through this this period of drawdown together. So it's not as though we're sitting there with a whole lot of different outcomes. People are living this all at once, and so that's one of the benefits of being from a community perspective, sharing those experiences and learning along the way. So we've gone through the period of drawdown there. You can see in excess of 12%, and more recently, since then, the period of drawdown, we measure it in depth, in percentage, but we also measure it in days as well to see how long, because both of those are going to have feeling. And you can see there that since that point in time, we continue to execute against a backdrop of all sorts of things in the news at the moment, remaining in the flow, and once again, we have reached an all-time high.
And this won't be the last 10% drawdown that this portfolio. That's why we showed you the slide at the beginning, where the public portfolio has been through 10% drawdowns. Yeah. Okay, and now just going on to the USA 9th of December, and this doesn't. That's 1 day out of date up there, but 10 positions fully invested, and this one hasn't come out of drawdown yet. It's slightly underperforming the S&P 500 Total Return Index, and I've put a value line there. Back on the 25th of April, just showing, and you can do this in your portfolio manager and your equity curve. This is the number of open trades down the bottom here. This is the underwater curve, or the drawdown curve, whatever you want to call it. And this is the percent invested through the life of the portfolio. It tracks that as well. Obviously, it goes down when you've got less trades in, but importantly here, we were at 100%, coming down through this drawdown. And then we got to 10 fully invested positions, but we were only 87% invested. So we want to use this as a learning opportunity to point out, how that happened, and that will undoubtedly be playing some role in why there's underperformance here. Because remember, as a trader, not only a mechanical trader, a trader is your number one objective for the analysis, the process using, whatever it might be, even if it's not a mechanical system, is to get all of the capital that you've allocated to that strategy, to that satellite, invested in the market for as long as you possibly can. And you do that without fear of what may happen, because if you only invest half of it, well, then you shouldn't be measuring the whole amount of money against an index, because the idea is to get it fully invested. And what you're doing is you're trusting your process, your exit mechanisms, to protect you from having too large a loss and having too deep a drawdown. If you don't have your money invested according to the rules, then you are making mistakes. Yep. And we need to fix those mistakes.
Yeah, because your benchmark is invested 100% of the time.
Correct.
So, this is the thing. We want to make sure that we try and get that number up as high as possible. So there's some lessons here, Gary. What's one of the lessons that that it's attributed to perhaps being a little bit underinvested compared to where ideally we'd like to be?
Well, the one that is the most obvious one is the fact that you've got a small amount of money here.
Yeah.
So how much capital you have does count. The more capital you have, the easier it is to make money. And if you have a small amount of money, then you are definitely going to have some obstacles that people with more money don't have. Yeah. And in the US market, where we've got high priced stocks, sorry, I've taken that off here. That should have been in here what the price was. But these Melly and is a $2,000 stock. FICO down here, you'll see there's the price, and there's also a $2,000 stock. Sorry, I'm missing a column over here. Netflix is near $1,000, I think, which means that when you got which makes some of these stocks, makes the portfolio not as divisible or as what you'd like it to be, because these position sizes are the price of the stocks are just too big relative to the position size.
You can see there that Melly, as an example, there's one, and we allocated $2,000 to it. So
correct.
So if you've got a portfolio, if you were trying to do this with a $10,000 portfolio, you probably wouldn't even be able to take that position in Melly. And then when we take it, as you can see on there, most of the other positions are around about 10%. This one's only 6.5%. So if that stock happens to do well, then all of a sudden we're underinvested. It doesn't do as much heavy lifting as the others are trying to do.
Correct. And you can see that FICO here was only 5.86%.
Yeah.
So what do we do about that?
Well, there's a couple of different ways that we could handle it. You know, we could say, well, look, those with the given amount of capital I've got, if I'm going to participate in all those stocks, I'm going to have this issue.
Correct.
So one thing you could do is you say, well, look, I'm going to take those stocks out of my universe, and that will at least help me when I'm investing to get that higher exposure.
Correct.
Yeah. The other alternative, I suppose, is you could use CFDs or a form of leverage, potentially to give you access to extra capital to fill those. But that's getting a little bit complicated, and that's a higher skill set than what ideally we're looking to start off with.
Because that's leverage. That's bringing leverage into it.
That's right.
And watch your space. There's still a lot of work happening in the background for using Sparta Investor with leverage.
Yeah.
And the other one obviously is to tip more capital in. But what we're doing here is we're going through Learn to Trade Properly study group, where the idea is this is about skills acquisition, right? And these skills are certainly what we're following as a mechanical system, which is the analysis part of the whole process. But these skills are not analytical skills. These are process and mindset skills, right? Discipline skills and consistency skills. So that those are the options that you have. But as you go through, as you come out and achieve the skills objectives that we've set in the skills acquisition plan, then you can add more capital, and then you can have a look at your universe and decide when the time is, depending on how much capital you have to invest and manage, when you bring these larger price stocks in.
Yeah, and that's a key point, that Learn to Trade Properly is about this evolution and development of skills and habit, and testing ourselves, because you're going to get to a level where you're trading at the moment and you're going to start to feel reasonably comfortable in that. You've gone through the periods of drawdown at least a couple of times and stayed in the flow and come out of drawdown, and you're starting to realize, look, I do have my skill set has improved, my habits are changing, and that's a time in which you can start to add more capital. And so some of these learning issues are not such a big, they're not such a hurdle to overcome.
Correct. Net practice.
Yeah.
Okay, the ASX, we'll go through these pretty quickly. ASX 3rd of February, 9 positions, fully invested, 97%. And that has also come out of, there's the 10% drawdown that was achieved back then in March. That would have been April. That would have been that round about Liberation Day, and come out of drawdown. So achieved the first skills objective into drawdown and coming out into a new all-time high. Yeah. The USA 3rd of February also at 10%, 10 positions, fully invested, 98.2, but similar. This has suffered a similar thing, and you don't have to repeat it, but we can see that we were 92% invested there when we had 10 full positions. There's the drawdown, still below 10% drawdown, and lagging the S&P 500 total return index. Right, just to finish, a couple of examples that we want to talk about. So we all talk about all the time about learning to trade properly. Let's give an example of somebody who's not learned to trade properly. And this is from Francis. Back in January 2024, he decided that he was going to take a break from trading because market conditions, quote unquote, are really bad right now. And since then, because I don't say this flippantly or to embarrass anybody, is that just by using Mark Douglas's terminology, is that Francis must have known what was going to happen for him to decide that at the time. So that is why we pushed. Anything can happen, right? And you do not need to know what's going to happen next in order to make money in the market. And the idea that we keep on, people who haven't learned to trade properly, or people who look at variables, Trump, look at the America, look at tariffs, and they keep on looking for reasons not to do something. And you really shouldn't. You should have a neutral mindset about anticipating the future and what you think may happen.
That's right. He's putting expectations that, on past experiences, therefore this is going to happen into the future. He has been bitten by a dog, and so therefore every dog that he sees bites. And therefore, what's his rationale? Well, I've got to take myself away from all the dogs because I don't want to get bitten again. So he's taking himself out of the flow.
And when you take yourself out of the flow, you take yourself out of the endless stream of opportunities that are available to you in the market. And people who do this are because they haven't accepted the risks. They haven't learned to trust themselves and their execution, their process, their analysis, their system, and they haven't learned to trust the market, which has an upward bias. And they certainly haven't yet, because of that, got the confidence to execute the way that they should. And if they haven't got confidence, they're not going to be consistent. They're going to be inconsistent. They're going to be erratic. They're going to do things like taking themselves out of the flow, and they're going to wait on the sidelines, become a spectator until conditions improve. Well, what are the criteria for the conditions improving? Okay, this hasn't gone up. This equity curve of being up 23% since the middle of January, when Francis decided to take a breather, hasn't been a straight line, right? We've had two decent drawdowns over here. So the point is that the market, the nature of the market, the uncertainty, the endless uncertainty that exists in the market is always going to test you. It's going to test your analysis. It's going to test how you think. And there's no system. There's not a system. There's no analysis. Nothing on the planet that exists that is going to remove that emotional pain of drawdown periods and times where the market does what you don't want it to do. So how do you fix this problem? Well, it's not by changing your analysis. There are plenty of analyses, methods out there that are profitable. What's not profitable are the people who try and execute those analyses. Why? Because as one customer said, he's still looking for the Holy Grail, right? And he said it in tongue in cheek, but it does not exist. The Holy Grail, as one of our customers, Jürgen, said, is in how you think. That's the Holy Grail. It's not in analysis. Won't be found there.
Yep, absolutely. And a lot of people think that success is a straight line, Gary, and it doesn't matter what area of life you live in. Success is not a straight line, and you can apply that to any facet of your life. And there's going to be trials and tribulations, and the only way to grow is to put yourself right near the edge and develop the skills in a stressed but not too stressed situation. Correct. And if you can do that, then you'll develop the skills. And a lot of people, what they try and do is they try and force the issue by using too much capital to start with, put themselves under way too much pressure, and as a result they crumble. They haven't established those basic habits, those foundations, the way to think in order to survive in that level of stress, such that they can increase the level of stress and therefore have a larger portfolio, add a little bit further capital, and so on and so forth. So traders aren't born overnight. No. It takes a long time to develop that mindset. I think we all need to take a step back and think about that, holistically.
Probably longer than most other things that people do. Absolutely. I think it was Larry Williams who said, when they asked him what is the biggest hurdle problem that he sees, traders and why they fail, and he said they start with too much capital. And therefore when you're still earning, your absolute losses are big. The percentage losses are probably not that different, but the absolute losses become big and you really get scarred mentally through having those large losses, through having too much capital to start. We'll do one more and then we'll finish the session. This is Ronald. The SPARTA investor is down more than 13% in the last very, very specific 2.67 years. Last index is at least in positive territory, and this was in July 2024, and it was towards the end of July. So I went and put up a chart, and he is quite correct. There's the blue line, and he took the absolute peak from 2.67 years back in 2021, and there to that date when we got this notification from him, certainly we're down 13. Is that 12.5? 12.5%. So there or thereabout. Right, whereas the accumulation index was up, 19%, and the actual ASX 200 had made a new all-time high. We know it fell back into the range again, but it was running at 5.9%. So absolutely spot on. And this was a really testing time for a trend-following system. Most trend-following systems struggled in over that period of time, where there was a lot of sideways movement in the market. But since that date, the SPARTA investor, because Ronald knew what was going to happen, SPARTA investor was going to continue to underperform, tongue in cheek. But from that date, it's up it's up 24% compared to 11% in the accumulation index. So double the accumulation index performance since then, and made a new all-time high. And the index has also just made a new all-time high. So people who know what's going to happen based on past experience, haven't learned to trade properly yet, and haven't learned the path to consistency, acceptance of risk, total acceptance of risk, trust, being objective, having objective decision-making process, trusting, having confidence, and being consistent. And consistent means executing in all market conditions. So just to sum up, this is a quote from Mark Douglas. Events that have probable outcomes can produce consistent results if you can get the odds in your favor and there's a large enough sample size. So how big that sample size is dependent on market conditions. We don't know. You can't pick a number, 20, 50, 100, whatever it is, and say, therefore, that's a big enough sample size. Casinos can go for many spins, hands, and lose, but they know they've got an edge in their favor, so they continue to execute, knowing that that edge is going to play out in their favor at some stage. And you can read, this is all in chapter 7 of Trading in the Zone. Some homework for you to go and read it, where Mark talks about trading like a casino, where you are the house and you're not the punter. If you go to the market without an edge, well, then you're the punter. So SPA3 Investor certainly has that edge over a large enough sample size, 9.4 years of live trading on the back of the data going back to 1992 to research the edge. So that's the research data. And the point to finish, as you've probably pushed a lot, is that every edge will get tested. There's no analysis that's not going to go into drawdown. So you will get tested to continue to execute your analysis, whatever it is, right, to continue executing it through adverse conditions over a large enough sample size to allow that edge to come through. Otherwise, you're just going to be chopping and changing edges, analyses, and you're just going to be in that endless, you'll never sort out how you feel. You'll never become comfortable with being uncomfortable. You're always going to think that analysis is going to solve your problems, and it never will, all on its own. So thank you for your time. Are there any questions?
So Nick, it says, if you doubt the bull, you will not be able to change mindset. You have to believe in the bull, or you end up being a victim of the wall of worry, i.e. your own emotions. Most need help with this.
Correct. Thanks for that, Nick. And Don was also saying, we haven't got beyond charts up, but Don was saying that the XJOA has not had a downswing on the swing chart since 7th of April. So it's just one big long swing up, absolutely. Yep. And that's on a 3-day swing. Yep. Okay, we'll end it there. Thank you very much for your time and attendance. Hopefully that's hit the mark. I'll be back in a couple of weeks' time where I'll do a market status update. Until then, we wish you consistent, objective, and peaceful, active investing and trading.